of cycles vary. Now, many people who first come to Hurst's cyclic principles or Hurst's cyclic theory tend to have the fixed opinion that wavelengths must be absolutely fixed, because many other cyclic theories demand that wavelengths are absolutely fixed. And if it's a 4.5-year cycle, then it must be exactly 4.5 years. One of Hurst's principles is the principle of variation, which tells us that cycles can vary in wavelength, and in fact do constantly vary in wavelength, which means that we can expect the 4.5-year cycle to vary. Hurst actually never set any limits. When I was creating Sentient Trader, because software likes things to be in black and white, I had to actually define a limit, and the limit that I defined for the length of a particular cycle was from 65% to 150% of that cycle wavelength, which means that a 4.5-year cycle could in fact come in at basically 65% of 54 months, whatever that is. It's 2/3 of it, so it could come in as short as a little over 36 months. Now, there are reasons why the cycle is unlikely to come in at 36 months. The main reason being that the cycle shorter than the 4.5-year cycle is of 18 months in length. And what is very important is that all cycles, according to Hurst's cyclic principles, have synchronized. And so in the current 4 cycle, which we are seeing on our charts at the moment, we have seen 2 18-month sub-cycles, or 2 18-month cycles, which are fitting snugly into the current 4.5-year cycle, and you can see them here. They are the yellow cycle. So if I draw them a little bit above the phasing and the price movement, there's the first 18-month cycle, there's the next 18-month cycle. Okay, so now we're expecting a third 18-month cycle to occur and to lead price down to a trough, which will be the synchronous trough with the 4.5-year cycle. So cycle lengths can vary. Okay, now as John and I see, I see a few other chat comments, so let me try and sort of keep up with those as well as talking about things. John says it's the first 4.5-year in the 9-year cycle. Okay, so let me just continue this discussion. We're talking about whether the 4.5-year cycle might come in early, as John is suggesting it might do. The 4.5-year cycle, as we know from the principle of variation, could be shorter or longer. Now, whether a cycle is shorter or longer will often have to do with the underlying trend of that cycle. The underlying trend is the sum of all cycles longer than that cycle. Okay, and so if the major trough in 2009, March 2009, if that was a trough of the 9-year cycle, which is not indicated on this chart, because you will note that this chart only goes up to the 54-month cycle. It hasn't positioned any 9-year cycle troughs. But if the trough in March of 2009 was a trough of the 9-year cycle, then we would expect, of course, 2 cycles of the 4.5-year cycle to fit in before the next 9-year cycle occurs. And what will often happen is that the first of those 2 shorter cycles will end up being shorter than its average wavelength, so shorter than 54 months, and as John suggests, will occur in less than the expected average length of 4.5 years, which is why John is saying that he's expecting that it might come in early. Of course, other clues that we have as to that cycle trough, the 4.5-year cycle trough, will actually occur, is to have a look at the breakdown of the shorter cycles. It seems fairly clear and obvious that that the second 18-month cycle trough must have occurred on the 1st of October in 2011, which was over there. As you can see, according to this analysis, and if I draw a little arrow, there's the trough. There's the first trough of the 54-month cycle. Here is, of course, the trough of the first 18-month cycle, and there is the trough of the second 18-month cycle in early October 2011. So another way of projecting forward would be, of course, to measure the length of time from that trough. We expect that cycle to be about 17.9 months long. So that trough will experience a synchronized trough with the next trough of the 54-month cycle, and we expect it to be the average length. About 18 months, a little bit shorter than 18 months, places us in the beginning of March 2013. If you look at the bottom right-hand corner of that chart, you'll see the current average length of that 18-month cycle is running short at 15.9 months. And if it continues to run short, then we could expect that trough to come in, I think that looks like February, right at the beginning of February 2013, and as John is suggesting, it could occur even earlier, towards the end of this year, in December this year. It's not impossible that 18-month cycle will turn out to be 14.4 months in duration. So I hope that helps to elucidate some of those concepts. We jumped from beginner level to extreme advanced Hurst cycle principles within 5 minutes of today's Trader Chat. I hope everybody's still with us. So let's go back to basics and take a look at what's happening now in the markets. Go back to some more basic sort of principles. I see a few other chat comments. Jose had a right, so there's an interesting discussion about the 6-year cycle fitting with European behavior, and John taking a look at the Toronto market, which gives a good 9-year cycle for 2009, and so some discussion around that. Some sort of advanced discussion going on there, which is great. Bruce suggesting a drop at the end after the November elections. Yes, exactly. There are lots of interesting suppositions going around about the fact that, of course, it's election year in the States, and so what might happen in conjunction with the fundamental events of the elections taking place in the United States. I won't be drawn into a long discussion about fundamental events interacting with cycles in today's Trader Chat, but let's take a look at what's happening in the market now. Okay, so having established, of course, that there was a very major trough in March of 2009, either 4.5 years or perhaps 6 years or perhaps 9 years. Ever since then, we have, since the March 2009 trough, we have seen 2 cycles of the 18-month trough, to the third 18-month cycle, and let me change that resolution. Then you can see here what has been occurring, as they say, early October 2011, which is the final 18-month cycle, which should be peaking roundabout now, and well, between now and sort of a midsummer for the northern hemisphere, and then of course heading down into the trough expected in early 2013, or perhaps early towards the end of 2012. You'll see again here in this particular sort of zoom level what I mean about how these semicircles often form either a resistance line or what looks almost like a moving average that the market moves round and about. Whenever the market moves round and about a semicircle in that fashion, I take it as a very rough indication that probably the analysis has a good deal of validity to it, because it means that cycle is particularly clearly visually apparent in the data. And although using terms like visually apparent when you're talking about technical analysis is something that many people will frown upon, when using Hurst cyclic principles, Hurst's cyclic approach and his phasing analysis approach was, of course, to use the visual signs that we can see with our eyes and use our advanced hopefully human brains to process and to decipher the cycle information. John says the US markets are surprisingly bullish and very right translated in this 4.5 year cycle. So that is a very important comment. And let me just zoom out back again to look at this 4.5 year cycle. What do we mean by right translated? Right translated means, okay, in its simplest terms, when people consider cycles in the market, people imagine that a cycle looks something like this semicircle that I've drawn here. Okay, when you ask somebody to draw a cycle on the market, they will draw something like this. Okay, that's what most people will draw when you're talking about cycles. They'll draw something that looks like a semicircle or a parabola, all right, or a sine wave. And the general idea of any particular cycle is that the peak occurs in the middle. Okay, so you've got a trough at the left, you've got a trough at the right, and the peak occurs right in the middle. In terms of a cycle being right translated, considering the 4.5 year cycle that we're looking at the moment, what that means effectively, and it's most in rather simplistic terms, what it means is that the peak of the cycle is occurring at the right-hand edge of the cycle. So in other words, we have effectively a skew cycle. Okay. And the peak is occurring further to the right than the center of the cycle. Okay, that's a simplistic way of describing it, but I think perhaps I'll leave it there rather than going into too much more detail about that. But as John points out, the current 4.5 year cycle is right translated in the US, and as Jose's mentioned, that's a big difference at the moment between the American markets and the European markets, is that the American markets are right translated, the current 4.5 year cycle. The European markets, however, are not. European markets, if we have a look at them, and there's not going to be time, I don't think, in today's chat to go into that, but the European markets are not looking right translated. So I'm going to start, I'm going to buy various people microphones and send them to them so they can get involved in in the discussion on a verbal basis. So let's get back to what's really happening now. As John has pointed out, the US markets, and these are the US markets that we're looking at here, of course, the US markets are strongly rightly translated, which means that the current 4.5 year cycle has a peak that has occurred late in the cycle. Right translated cycles tend to be very dangerous cycles. In my opinion, or in my experience, they tend to be very dangerous cycles because the bullishness, if you like, lasts for a very long time in the cycle. Now, this cycle must come down and form a trough. Okay, the 4.5 year cycle. Now, according to Hurst cyclic principles, I've done sort of various rather arbitrary and dangerous drawings on this particular chart, and people have a tendency to assume that the next trough of the 4.5 year cycle must be down roundabout near the level of the previous one, which is March 2009. In fact, that is not necessarily true. If this is a bullish shaped cycle, which it looks as if though it is, right? Because it is right translated. Right translation is the first sign of a cycle that has a bullish shape. So if it is a bullish cycle, then the next trough of the 4.5 year cycle, while it does require some